Hello, everyone. Give everyone a few minutes to join. All right, I think we've got pretty good attendance. I'm sure people will keep trickling in, but we'll get started. Thanks again, everyone, for joining. I'm Mike Wiesenbarth. I'm the head of partnerships with Escalon. We are here for our Meet the V series with Ihar Mahaniok, who's the founder and managing partner of Geek Ventures. Ihar, if you want to do a quick intro.
Thank you, Mike. I'm glad to be here. Thank you for inviting. I'm Ihar Mahaniok. As Mike already said, I run Geek Ventures. We invest in early stage immigrant-founded companies. We have invested in more than 40 companies already and planning to invest in about 10 companies this year.
Great. Awesome. Excited to learn some more. Before we get started, I'm going to let Christian Bennett from Ramp and Peter Caddison from Vistra here as well. They're two of our sponsors for the program, so I'll let them introduce themselves. Christian, why don't you go first?
Awesome. Hello, everyone. Thanks for letting me hop on today. Little quick overview about Ramp if you haven't heard about it already. Ramp's a great startup tool for growing companies. They often face unique challenges managing their finances while trying to scale rapidly. And so Ramp's intuitive spend, expense, and AP platform helps those startups streamline those expense management process on that side too. So it's a next generation spend management platform, corporate card, AP, reimbursement, and expense management platform, making it easy for you guys to save time on the back end with controlling employee spending and help forecast quarter after quarter as well. So I'll put in some additional info in the chat so you guys can learn more if needed. Thank you.
Thanks, Christian. Peter, go for it.
Thanks, Mike. Hello, everyone. So Vistra is a global accounting firm, but really we have an interesting niche because we enable U.S. tech companies to access global markets and access a global workforce. So we're direct operations in 80 countries, and what that means is there's a lot of low-cost strategies to seek additional revenue and to enhance your workforce with entities or without entities, with payroll, through contractors. We help sort it all. Any client of Escalon has access to our advisory team. And so you just need to reach out via Escalon, and we can arrange a consultation to help assess what your needs are and how you might grow your revenue outside the U.S. Thanks, Mike.
Great. Thank you, Peter. Okay, awesome. Well, we'll jump right into it, Ihar. I think, just so everyone on the call knows, Ihar, like we mentioned a couple times, managing partner, founder of Geek Ventures, but also just a long-time angel investor, early stage investor, has had, a ton of success. So Ihar, maybe we start there. Give us like the longer backdrop of you, maybe covering your engineering career, some of your successes even before Geek.
Thank you. Yeah, I grew up in Belarus, and after I graduated from school, I went to work at Google in Switzerland as a software engineer. Was working there on improvements to Google search, Android, and so on. Moved into ML AI space. Then went to work for Facebook, led AI ML teams there. Worked for a couple startups after that, also in the AI space, leading engineering teams. And in parallel to all of that engineering work, I have been doing angel investments since early 2010s. And as I was doing angel investment, initially it was a hobby. It was like something on the side, something to get myself to more on business side in addition to technical side. And then I found out that that my deal flow is getting really, really good. I meet amazing entrepreneurs. I'm able to pick and choose the best ones, and we had some good successes so far. Right? So 5 of my investments became unicorns, all the way from seed to became public companies, Instacart and Zoomcar, and had very significant returns. And I found that founders are seeking me out. And when I went to work for startups, my ability to invest as an angel decreased. So, and then that was around the time that I realized that I really like investing, and I want to be investing more. I want to have higher ability to actually have a solid impact for startups. I want to do full-time investing, and I started raising a fund. I decided to go into specific focus on investing in immigrants, because that was my passion. I'm an immigrant myself. I came to the US 10, 11 years ago already, and learned how to, operate here, how to navigate the different culture, how to build my network from scratch. And I was able to help immigrant founders with that. And since 2021, we've been growing the team at Geek Ventures, raised the first fund of $23 million, and invested in 40 companies already. So by now we have a team of 6 people, actually all around the world, and we are working on finding amazing companies. We run events in New York and in San Francisco, and the next event will be in a couple of weeks from now here in New York. We expect more than 100 highly selected founders and investors. So yeah, that's roughly the story.
That's
An important note, we already had an exit from portfolio. On my personal portfolio, I had 15 exits, and on Geek Ventures portfolio, we already had 1 exit so far. Yeah.
That's quick, starting in 2021. Could I ask, just before we get too far into Geek Ventures, like I kind of find it fascinating, I think the story within the venture capital community, like it's all about access to the right companies. It seems like these days, a lot of people have been able to build funds over the last few years. Why do you think you were in a position to get the access that you had? Was it what you'd offer from a value standpoint? Was it just people, networking? Like, where did it come from?
So several angles here. First of all, the network and knowing people, and being somebody who they think of in terms of who to reach out to, right? So over this year, so I have several sources of network. One, because I worked at Google and Facebook, I know a lot of people who had amazing careers over there, and left and were starting companies. And I would be one of the people they would think of to reach out to as an originally angel investor and then as a VC. Then, of course, I knew a lot of founders, and both founders that I invested in and founders I didn't invest in but had good relationships. And these founders would introduce me to other founders, because, a lot of founders know other founders. It's very common for them to communicate and share introductions. And often founders of a big successful companies, like, my good friends are founders of PandaDoc, where I was the first check. They would tell me about their own employees leaving to start a company, right? So, and knowing these founders and having good relationships with them, and these founders want to introduce me to other founders and to their friends. And then I'm I have been building a significant network with other investors, right? So because one of the things that is good about investing in the early stage, pre-seed especially, VCs and angels, this is a very collaborative market. It's very different from Series A, Series B, where one big company, one big VC is typically taking more than half of the round. On pre-seed, it's very collaborative, right? It's very common for us to participate in a round with 3, 4, 5 other VCs. So building a significant network where we help each other with other pre-seed and seed VCs, we end up seeing up 50 to 60 companies every month where other VCs or angels invested, and they vetted the deal, and they really endorse the company. So all of that helps to build a significant deal flow that's highly selected, and that's how we were able to look at 2,000 plus companies last year. And I didn't even mention the cold inbound, right? So because Geek Ventures has built a reputation already over the last 3 years with our events, with the press and everything, and people reach out to us, and we look at every single cold inbound submission, and every single cold inbound email or submission through the form on our website. We look at all of them. Not all of them we are able to take a call, but we definitely consider every single one, and sometimes the gems come through.
Great. Well, that's great, I think, for the audience here to know that there's some firms out there that are taking those types of things. And one thing, maybe we'll weave this in later in the conversation, but based on what you had said is just, working at Google and Facebook, getting in with the investors. I know in some of the previous interviews you've talked about like being in that bubble and how that can affect founders. And well, maybe we could talk a little bit later about advice you'd have for founders who are trying to get into that bubble that you say. But I'll back up a little bit. I mean, you gave us a great overview of Geek Ventures, started the firm in 2021, makes, pretty seamless as to why you guys would have started the firm. Can you give me a little bit of just the story around the founding of it? Because I know there's a few of you there. I believe you had mentioned in an interview too, you have a key co-founder that is sort of a COO, but still operates at a startup. So maybe talk through like how you picked your team, what you felt like was the best way to get it off the ground.
You want a quick thing? I'll change the lighting and be back in a second.
Okay. Got it.
Okay, I'm back. So yeah, so the story of founding. So actually, 2021 was when I had a couple of offers to continue my engineering career as VP of engineering. And that was a time I was like, do I want to commit to another startup, of course, for several years and just be specifically focused on building a product, which is great, what I have been doing for 15 years before that, and continue investing on the side, or go full-time. And that was a time when a couple of people who co-invested with me, my good friends, angel investors, who liked co-investing with me so much that they encouraged me to start a fund and basically take the money under management instead of offering them co-investment deals. And what really helped me in 2021 that I came across, thanks to advice of some friends as well, of this organization called VC Lab. By now, it's way more well-known. Back then, it was on its third batch, and they basically are free accelerator for VCs. So they would help aspiring VC to start a firm. And I applied. I didn't think I will get in. I got in. And they basically take people who know how to invest and teach them how to build a firm. And this is a completely different thing than building a venture-backed startup, because there's full Amazon and of books on how to be a founder of a startup. There are so many great books like 0 to 1, Hard Think About Hard Things, and so on, so on, so on. What that means to be a venture-backed founder going to build a company that will go to unicorn or IPO. There's very little books on what it means to build a significant venture firm. VC Lab helped figure this out, helped to understand how to build the process and raise. And during this VC Lab batch is when I came up with a name and with a strategy and got my first commitments. And that's when I started, getting my team together. So Vadim was the first person who offered to join, and he wanted to expand his horizons. He has been and still is CEO of a Series A company, 3D Look, and wanted to also spend part of his time investing together with in a VC firm. And he believed in me, in my investing track record, and he wanted to help. He brought in some very interesting founders, deals. So I remember one of the first deals he brought was Great Shapes XR. So it's like one of the really strong deals in our portfolio right now. And it was two of us for a while, with me full-time and him part-time. And then about half a year later, when mid 2022, when the fund was already kind of half raised, we hired an analyst full-time. And one advice I give other VCs since then: don't postpone hiring the first full-time person. The sooner you have a first analyst or associate, the better you will be able to operate. So Max, he has grown since then into associate and really helped us to put everything into proper operational rails and to actually move from like just better angel investors into proper VC firm with much stronger processes. Then in 2022, we hired a second analyst, Sviata, who also grew into associate since then. And in 2023, we hired the principal, Alex, with 12 years of venture capital experience, who is really bringing a lot of excellence and high bar to our decisions. And an assistant / operations person, Masha, who is helping us to deal with everything that's not related to investment decisions. So overall, the team of 6 people, which I think is fairly big for a pre-seed seed fund of our size, but we were able to do it thanks to embracing remote work. Most of our people are not in the US, and this size and quality of our team helps us to make the really much better decisions than if I was by myself.
Great, that's excellent. I mean, it makes sense. I was thinking the same thing when you said that 6 for a firm that you guys just started. What is the plan going forward? I mean, how you've made 40 investments, $23 million fund. I guess, what's the average check size, and when do you expect to start raising fund 2?
So I can't talk about fund 2 publicly, unfortunately, because we are not, allowed to do general solicitation. But on checks, so we are doing checks from the first fund between 100 and 400K, right? Depending on the valuation, on the traction, and so on. That's typically the first check, and we are doing follow-ons into our companies when they are meeting and exceeding our expectations. So the largest company in Fund 1 already had close to 1.5 million deployed from us.
Okay, great. That's awesome. Well, I'll switch gears then. Just, we definitely want to get to some questions that are more founder focused and some of the feedback that we had talked about. But before, I'm sure a lot of people joined this call to just hear a little bit about the venture market from your perspective. 2021 probably looks quite a bit different than 2024 looks like from a venture perspective. So I'd love to hear, if there's any good stories around the changes that have happened, anything that shocked you, stumped the team in any way, and maybe even weave in like the industries that you invest in to give us like a perspective of where you guys are spending your time.
Yeah. So several things there. First of all, one important thing that there are 2 levels of fund operation. When the fund is investing over multiple years, it has to have a strategy that can sustain changes in the market, right? So the high-level strategy, we keep the same over multiple years. We invest in immigrant founders in the US at early stage, pre-seed and seed, meaning from idea to about $1 million in ARR. But specific sectors that we invest, or specific valuations that we consider, or specific angles, they change month to month, quarter to quarter, because the tactics of investing have to be have to go with the market, as well as sometimes pacing, or sometimes the check size could change relative to the market. So, and here are the biggest changes that happened since 2021 to 2024. And the biggest positive change is that investors have more time to make stronger decisions. 2021 market was where really strong founders would be able to force investors to make snap decisions in a couple of days or a week, which I think was really unhealthy for the market. And a lot of founders that were not as strong were able to use the same tactic. And then a lot of investors, a lot of even good investors who wanted to deploy capital in 2021 had to figure out how to make decisions in a couple of days, which means that they would have less information, they would be able to would not be able to dig deep, would not be able to talk to customers, would not be able to analyze the company properly, and would basically have to invest on vibes. While now, even with the best founders, we are able and willing to go deep, right? So for example, right now we are looking very deep at the company that we really like. I can't talk which company it is yet, but it's amazing founding team, but we are able and willing to go deep to understand their financials, to understand their product, to understand their competition, to talk to their team, to understand how they're building it, right? So actually all of the details, right? So, and in the end, it allows us to go from our funnel of more than 2,000 startups a year to actually selecting at most 10 to 20 startups a year. So, which is literally half to 1%, where at the very last stage on the investment committee, we are able to discuss 2, 3, 4 great startups with a lot of deep information to choose one of them that we feel has the highest chance to go to a huge success. And that's the biggest change. And the second biggest positive change is that the founders are way smarter with the money right now, much smarter. And they listen to VCs that basically share the thoughts on how to manage their runway. In 2021, it was so common for a founder to raise several $1 million. It felt easy for them, like in a couple of weeks, and then spend the several $1 million in like 6 months, and then go to market, try to raise again. And the problem is that when this kind of behavior continued in 2022, and then let's say by May, June 2022, they were not able to raise a continuation round anymore. So what I see now is that founders that are so good that they can raise in this harsher environment several $1 million, they really plan to spend it over 12 to 24 months. And I feel very comfortable with that. The great founders will be able to get to the next milestone before they will go again to raise at the market. Because, you know, if they have to go to the market in 6 months and they don't have a significant traction or significant product development or significant pipeline, then they might not even be able to raise a flat round, let alone the markup.
Right. Right. Okay, that's interesting. I mean, it's pretty good to hear, or maybe not good to hear, but it's pretty funny to hear the difference of term sheets being turned around in a week back in 2021. So, and then also, I mean, the second point you make too. I mean, if I did a self plug here, one of the reasons why Escalon exists is to help founders drive down costs. You know, hire a fractional CFO, make sure you're managing your burn, things like that. So would you say, did you guys make more investments in 2021 than you did in 2023? At like, was it a faster clip back then because you had to?
No, because the timing was perfect for us because we just started to do a first investment in the end of 2021. We started to deploy in December 2021. And we did a couple of investments in the end of 2021 and early 2022. But because the fund was small back then, the sizes were small, and we were basically had fewer small investments, which we were able to make faster. But then the market turned on us in Q1 2022, and throughout 2022, we noticed very quickly that the changes in the market allow us to spend more time and deeper discussions. And I think that in that case, right, so even though we are officially a 2021 vintage fund, but we have very low percentage of 2021 companies in the portfolio compared to funds that started deploying way earlier than 2021.
Yeah. Okay, that makes sense. That's awesome. Well, cool. Well, let me switch gears just to some of the founder-oriented feedback questions, things like that you and I have discussed at length ahead of this. But maybe just open up the floor, like pretty broad question. Like as you think about the types of founders that you guys have invested in so far, you know, obviously you guys are looking for immigrant founders. Are there any qualities that you look for in a founder, whether it's hard skills like, you know, only investing in technical founders, or anything else that you've kind of like noticed that's a common theme among the people that you've invested in?
So what we often look, so first of all, the companies might have multiple founders or a single founder, right? We support both cases unless they have 6 founders or more. But what we typically try to focus on is the main person in the company. And we also significantly prefer that the clear main person in the company is the CEO. We might make exceptions, but the CEO should be the person who is absolutely key and critical for the company, that if that person leaves, that will be the crisis for the company compared to other people. That should be the person that has the vision and has ability to sell this vision. The vision is paramount, right? So this person should have a vision that allows us to be excited, that allows their employees and co-founders to be excited, that allows their customers to be excited. That's where the vision and some salesmanship in the good sense of this word should be present in the CEO. And if the CEO cannot show us that they are building something big and unique and something that can be, you know, a multi-billion-dollar company with a, you know, and be a significant household name, then that would be something where we can stop. right? If they cannot do that. So the second thing is that basically a derivative of this, we are looking for founders and CEOs that can hire, right? So we're talking about hiring, we're asking them about their team, and we're trying to understand, are they able to convince the best people? Are they looking for the best people? Are they prioritizing hiring best people? Are they fine with rejecting people who are okay? And are they fine with firing people who are okay, right? As opposed to great. So this is a big thing. And another big thing is ability to move fast, right? So one thing that I always tell the founders, you should fundraise all the time and build relationships. And one of the things that is important is when you build relationships with VCs is that you need to be able to tell VCs good news about your company since the last time you spoke to them, right? So if I met a founder or we met a founder and we have been speaking with them for a month or two before we make a decision, we need to see progress during that time. If we met you on 1st of February and we come back to you on 14th of February or 1st of March, you should have progress in that period. You should be able to articulate that progress. You should probably build a few new features. You probably found new pipeline potential customers. Maybe you closed some deals. Maybe you grew your revenue, right? But when there is no clear progress, we really don't think it's a good founding team, right? So very strong, fast progress is important. And we are also looking for clear signs that this founder and founding team is ethical, right? So, and anything that has any smell of, low ethics or, focus on just money and greed and things like that, as opposed to actually building a sustainable business that will have positive impact, that's also something that is important for us. Yeah. So, and I mean, the greed as opposed to impact would be a red flag. Yeah.
Yeah, that seems fair. Seems fair to me. There's a few questions in the chat that sort of allude to this a little bit, or at least this might get us on the right track to answering those. What are, like, you have some expertise. I'm sure your team has some expertise. Like, what industries do you guys find yourself gravitating towards the most, especially now in 2024?
So we are looking at business models most of all, right? So, and the business models that we gravitate the most are B2B SaaS, especially vertical SaaS, or marketplaces. And as a VC, we are looking for outsized wins. And we found that marketplaces have, while they have a lot of risk, they have a highest reward because it's really difficult to displace a marketplace that has robust supply and demand balance. And on B2B SaaS, the clarity there is that when we invest in pre-seed and seed, they have the clearest path to Series A and Series B. So we do sometimes invest, as an exception, in deep tech, but only deep tech where there is a clearer path to revenue and Series A. So as opposed to some of the deep tech, which might take 10 years to get to any revenues or next round. And we are looking at health tech, but only health tech which is able to grow into billion-dollar companies or IPOs, as opposed to quick M&A targets for bigger healthcare. Yeah. So this is basically our approach.
Okay, no, I like it. I think it's good transparency. I mean, looking for it's a venture firm. Looking for the outsized winners is how your business model works. Speaking of, and this kind of goes back, we've touched on this question a little bit, Ihar, but like, how would you recommend a founder self-identify, whether they're a pre-seed company, a seed stage company? I know you've done angel investing. Like, have you met founders that say, hey, we're raising a seed round, and you actually believe they're ready for a pre-seed round? And like, what's the differentiation?
There are so many angles there. One of the important angles is, for example, the age of the company, right? I think the example of a bad term was a company that exists for 8 years and is coming to us with a pre-seed. I'm like, guys, you are already either a lifestyle business or you should be Series A company. Being pre-seed at this age of the company is something that went wrong. So pre-seed should be something that the company raises in the first year or two. And pre-seed is typically when the company either has just an idea or has the first customers up to let's say 100K ARR, right? So, and sometimes it might take a couple years, and the pre-seed can have multiple stages. But again, be very careful as like not signaling to the market that you're raising a pre-seed when they can look up on Crunchbase and you're a 5 or 6 year old company. And also from a valuation perspective, for US based companies, pre-seed valuations can go all the way from 2 million, maybe even 1 million rarely, to 8 or 10, where anything above 5 is pretty much reserved for repeat founders who had strong results before, right? If you're a first-time founder and you're raising pre-seed, most likely it's 5 or 6 million valuation at most. The seed is typically, by the way, I also differentiate first seed and second seed, which basically the market created in the last couple of years.
Yeah.
First seed is when you have between 200K and 1 million ARR, or you're extremely high level repeat founder, and then and you have basically one of three. Either you have between 200K to 1 million ARR, or you are very strong repeat founder without revenue, but people are willing to give you a lot of money, or you already have built a free product that a lot of people use, but you're just very early on monetization. In any of these cases, you can raise a seed, which is typically between 2 and 5 million, and the size of the round, and the valuation would be between 10 and 20 typically.
Got it.
And then there is this concept of, okay, so a company might have raised pre-seed, which is like 500K to 1 million, then they at 5 million valuation. Then they probably raise the seed, which is about 2 million at 10 to 12. And then they got to the point when they have 1 million ARR. The million ARR, or maybe 1.2, 1.5 million ARR, is often too early for a Series A. So that's when the second seed comes into play. And several of our companies successfully raise second seed, which is typically 4 to 6 million round at 20 to 30 million valuation, and or 15 to 30 rather. That would be the pre-Series A company that needs this extra capital to get to Series A, right? And then Series A round size would be typically 10 to 15 million with valuations, 40 to 100. And those companies can have a wide variety of revenue between 1 to 7 million ARR with significant growth. So basically, this is the map. And for us as a firm, Geek Ventures, we can participate with the first check with a pre-seed or seed. And we don't participate with the first check in Series A, but we do follow-ons in Series A for our portfolio companies.
Okay, great. I was going to ask that question, but that was very helpful. I think, we're recording this chat, so I think that'll be something for everyone to key in on. Is it seems like this, no one seems to really commit to what's pre-seed, what's seed, where do you become a Series A, what are the investors thinking about you as they kind of evaluate just the communication of the words used. So that was very helpful. Thank you, Ihar. We've talked a little bit about this already, but I'll kind of let you reiterate, like, how do you guys typically find new founders to invest in? But like, I know, and if I layer onto that, obviously you guys have your network, the people on your team that know people, the people that you've met over time, but maybe even more interested in the 2,000 companies that you evaluate, the cold intros or the cold inbox you mentioned. Like, how do people stick out for you guys there?
So we are very structured and process oriented. So for example, unlike other firms that like focus a lot on amazing cold email, for us, specifically in Geek Ventures, and can't talk about other firms, this is less important. What is important for us is structured information. And what we ask is to fill the form. And in the form, there are several things that we ask, right? So specific track record of the founders, what they did before. In this particular company, what is the traction? In this particular company, how much money they raised, right? And what they are looking for. And what is important is that, first of all, we have negative selection, right? So we are like, okay, which companies we are definitely not going to invest, right? The companies where we always ask to put what the valuation the company thinks or they're raising at. And if the valuation is way too high based on the traction and the track record, right? So we won't waste anybody's time and talk to them, right? So, but then another thing that negative selection is that if based on the description of the company, it's just too small or it's not venture backable, right? If there's it's a gas station somewhere, or it's a very small software feature, we will not even be able to continue the discussion there. But the things that do stick out for us is the track record again and again. What did the founders, especially CEO, did before, and how is their significant success before matches what they're trying to build right now, right? So this is where founder market fit comes into play. If you are building a healthcare company, you better have healthcare experience, right, and some achievements in that experience. So, yeah.
Okay, that makes sense. Very fair. Just, and then diving in, once someone does make it through that filter process and it becomes a live pitch, which is, I mean, it's great to hear that you guys can have, a few extra weeks to evaluate these companies before making a quick decision. But are there things that stick out in the pitches that you've heard? Are there things that you look for when you're listening to a founder speak the first time, like key metrics, key values, things like that they touch on?
So basically, I don't like the word pitch because we actually don't listen to pitches, right? So what we do is we create a dialogue with the founders, right? So it's like, and the strongest way to get a no from me is to come to a meeting and talk and not hear any questions from me, right? So that's the easiest way to get a no. And that happened quite a few times already, right? So when I cannot even insert my question, when the founder is like, wait, I want to present you my deck. It's like, well, we are not going to invest. So every single meeting that I have with the founder, we do not have deck being presented, right? So I don't want to look at your deck. So first half of the call, we always talk about the founder's background. So especially CEO's background, but other co-founders as well. Like, what did you do before starting this company? Again, we are investing early stage. And when we invest early stage, there is not enough information from the company itself. Typically, we want to look before to understand, are these people the right people to build a unicorn company? And the most important is to have their life story prepared in such a way that is exciting. That is like, when we hear from the founder that they built multiple companies before, they had a few exits, they've been entrepreneurs since 13 years old, things like that. That's what exciting. When we hear that they, led a team of 200 people and now they hired several of these people into this new company, amazing, great thing, right? When we hear that you got, became a laureate of some awards and you were really one of the top students in some amazing universities, that's also great, right? Anything from your previous life that shows that you're exceptional is really helpful. Anything from previous life that shows that you understand your market is great. So then basically after talking about your achievements, what we talk is the origin of the company. Can you explain us why did you become excited about this company idea? What brought you to this, right? So the best founders we see is they didn't come up with an idea by, analyzing the market like a consultant would, right? They came to it through their own pain, through understanding really the problem really, really well, through knowing a lot of other customers, to being themselves the customer that would know this pain point really, really well. And we would really key in on that. And then we would key in on, okay, what's the vision? And I always ask about two sides of the vision. One is like a large, high-level vision. In a second, I'll move my camera into a little darker side of my.
Moving on.
So and then the higher vision for the I think that's a little better. The higher vision for the many years from now. Sorry for all the shuffling. And then the other part is what you're gonna do in the next year. That's my camera. So what you're gonna do in the next year, meaning, so when we invest in you, we want to be confident in two angles. One angle, you're able to build $1 billion company, because if there's no vision for $1 billion company, it's not gonna be a good shot on goal for us. And second, are you able to raise the next round? And for that, because we are not a multi-stage firm, we are not able to sustain you for like the next 10 years. We need for you to be able to pitch to a bigger fund for a bigger round next year. So then the question, what's your exact plan for the next 12 months? do you have a plan that will achieve a significant milestone that will sound amazing to the bigger firm, which will give you a higher valuation? So these are a few things that I ask on a typical first call.
Got it. Okay. Okay, that's great. So yeah, distilling it back, and because there's been some conversation in the chat about this, it's basically to get to the point where they're having the conversation with you, they need to, you know, be able to show progress in the form that they fill out to get your guys' attention. And then when they show up, it almost seems to me like they need to prove that the reason why they're starting this company is to solve a problem for a customer that they know exists, not just, you know, found a company for the sake of being a founder. And just quickly, I mean, decision-making process at Geek Ventures, I think a lot of people from the outside looking in get curious about these kind of things. You guys have a small team of 6 people. Is it, you know, you making the decisions by yourselves with the deals that you source? Is there some type of, you know, democracy voting situation? How does it work?
So we have a system that is a little less less strict than a lot of people would expect, right? So the way it works for us is that we always have a deal champion, so presenting a deal, and it could be any one of us. And if there is no deal champion, if nobody is excited in the beginning, then the deal cannot go through, right? But then if there is a deal champion, somebody is very excited about the company, who is willing to take multiple calls with the founders and the customers and build a case, yeah, that's extremely important for somebody to be. So then when we have a deal champion, and everybody could be probably champion of a couple deals at most at the same time, typically like even one deal. And then because we have several people on IC, we typically have multiple companies presented by multiple deal champions. And we discuss every single company from its pros and cons. The interesting thing there is because it's early stage, we have to be very careful is not to bring the company down, because, you know, every early stage company has risks, every single one, right? So obviously, right, we don't invest in companies with PMF. We invest in companies that are searching for PMF. So it's very important to not knock the company completely down, but at the same time, it's important to raise the red flags, right? And there are so many red flags that could be like, okay, if they don't know how to spend, if the founder is likely not to stick around, if the vision is not too big, or if the market is small. So every member of the team should raise red flags that maybe the champion didn't notice. And then when typically we have the company discussed, everybody suggests what other questions we need to follow up. And typically one company, after coming to IC, it comes back to deal champion with the questions, and then it comes back to the IC next week when the questions are answered, right? So, and when we don't have any more questions, what happens is that typically when we have a couple companies on IC, we basically do elimination, right? And this really helps us that to maintain the bar high, is that when you have 2 great companies or 3 great companies present at IC, and we are able to eliminate 1 great company, that one that even greater are staying there. And that's the hardest point to give feedback to entrepreneurs, because when they say, well, unfortunately, we decided to pass this round, and the only reason why is because there is a better deal, right? And it's nothing you could do about it as a founder, because we don't have a feedback to the founder is like what they did wrong, right? So, or what they could improve. It's just because like, you guys are great, but we only have so much capacity, right? So, and but at the same time, for the firm, it really helps to build the best possible portfolio. So yeah, and in the end, it's kind of between consensus, democracy, and the final vote. Because here's the thing, I'm the solo general partner, so I am responsible for every single deal, and I have to basically be in on every single deal. So there is no company in our portfolio that I didn't vouch for and I wasn't excited about, right? So every single company we invested, I said, yes, we want to invest in it, and it's great. So basically, if I cannot get excited about the company, or the company is not as strong for me as some another company, then we will pass. But at the same time, we typically wouldn't invest if I'm the only person excited, right? So after all, we have amazing, smart people in the team. And if I'm the only person excited about the deal and nobody else is excited, then we probably will not invest. Thankfully, we have a great a great portfolio or a great pipeline. I mean, to find amazing companies.
Amazing. That's fortunate. And I like that, having some people around you to check you a little bit on those decisions. Wanted to spin it into something again, we covered a little bit at the beginning, at least when you were angel investing, but how you guys support companies once you do invest. So maybe we could start, just because you've been, you guys think about introducing the company, the founders you invest into, that next level of venture firms, how you guys maintain the relationship of the people who will carry the Series A, tactical things, obviously strong technically, how you guys support them in that way.
So what we found is the most important and most helpful to founders that help them in the fundraising. And the interesting thing that is also the most repeatable for us, right? Because when we invest in companies from different sectors, one thing they all have in common, they have to raise. And the fundraising process is more or less the same for everybody. So we help a lot with strategizing about fundraising, planning fundraising, negotiating. So right now, for example, yesterday, one of my founders asked me to huddle with them to discuss how we push back on a term sheet. So basically, another firm gave them a term sheet for a multi-million investment, and the founder sees some terms they're not familiar with. So what we do is I always find time the founder to understand and push back and negotiate every single term sheet. And this happens like every month or so with our portfolio founders. Then helping them to find those term sheets, but basically introducing them, right? So several hundred VCs are in my Rolodex. I'm finding the ones that are right for this particular company, for this particular stage, and introducing them. I am running a couple of communities of investors, VCs and angels, which I use to promote the companies we invested in, to basically find other people who would want to invest or support. We also are happy to find advisors, one-off or long-term, among our LPs and elsewhere. We have an amazing LP base of 70 people that is really helpful to founders. And when we do SPVs, which we do fairly rarely and typically on the next round, this is another way for us to find more supporters of the company, because what we found is that when people put money into SPV, and we typically have fairly high minimum, so it's significant money for somebody to put money into SPV, which is invested in one company. These people are become so interested to help this company in any possible way, right? So that the company gets these advisors without having to spend advisory shares or anything, for free, right? So all of this on the fundraising and advisory side. But of course, we also help them with events, with kind of like, for example, as I mentioned, that our events in New York, San Francisco are specifically there to help our portfolio founders meet other founders and investors, right? So we do mentorship sessions where we invite external people to talk about specific topics. We had recruiting mentorship, we had PMF mentorship, SEO, fundraising, and so on, by somebody external coming and giving it talk to our portfolio founders. And sometimes even we invite non-portfolio founders. By the way, watch my LinkedIn, because when we have capacity on these webinars, I post it on LinkedIn typically 1 or 2 days in advance at most. And those founders that respond, we typically add 3 to 5 external non-portfolio founders to just join as listeners on those webinars. Yeah.
Mm-hmm. Oh, that's great. Great way to build the ecosystem. And I don't know if we have yet, but we'd love to contribute at Escalon. If you need an early stage CFO to give a mentorship discussion, if that fits into your content, let us know.
We'll get back to you on that. Yeah. Thank you.
Yeah, got it. I like it. Okay, cool. Well, that's super helpful. And then what I'll do is, we've got 10 minutes left. There's been a handful of questions in the chat. We'll try to get to a bunch of them at the end, and feel free to drop some in there to everyone who's still on. Ideally, they're not specific to your company, but more just broadly speaking, trying to get something that can help the group from Ihar. But Ihar, I'll start to wrap things up. As you think about Geek Ventures, the next 12 to 18 months, probably fair to say it's unpredictable, but what are the goals for you? What are the goals for the firm? Where do you see things going?
Great question. So we want to build I want to build a sustainable firm that will have significant impact on the ecosystem, especially so on the immigrant ecosystem, and I really like you know, finding my niche and supporting this niche. And doesn't mean that, you know, non-immigrant founders are any less, but you know, you always need to focus somewhere. So, and maybe in 5 to 10 years we'll have multiple funds. Maybe we'll have multiple funds in parallel. Maybe we will expand beyond investing in just US. But most importantly, we will keep increasing our ecosystem. We will keep helping portfolio founders and non-portfolio founders with our events and other things. And we will want to help our portfolio founders become investors themselves through our firm and other firms, and basically get their success. We want to get more people to become founders, and through, you know, starting with employees of our portfolio companies, helping our LPs as well to become founders, which is also a very interesting angle, and helping through content and conversations like this, understand other people how to raise their first money. So basically increasing the ecosystem. And then in the end, we are too early for that, but maybe in 10-15 years we will help our portfolio founders to find good exits like IPOs and so on, right? So, and to have impact there. But in the end, what is really, really important is for Geek Ventures to become a firm that has a positive impact on the world, right? And I think in general, technology is the great way to do this, right? So technology in general helps people be more productive. Technology allows new ways of living, communication, of you know, connecting, or anything else, right? So, and hopefully we will have stories where Geek Ventures was some kind of a contributor to a new technology that is important for the world. Yeah.
Great. Okay, that's awesome. That's a great goal. And I'm going to shift gears. There's been a handful of questions that we've been filtering through that come through the chat. One that's come up at least twice that I've seen is just kind of the strategy around like a founder who's having success and they've been bootstrapping versus, you know, raising a little bit of capital. Is there, you know, is there a thought that you have, an opinion you have on how capital can help a founder, maybe how sometimes a founder doesn't need capital, anything that you can rattle off from that standpoint?
Great question. So in general, we have the most understanding of the companies that can be venture backed, right? And what is important is that less than 10%, maybe even less than 5% of all companies can be and should be venture backed. And sometimes I see the companies that definitely shouldn't be venture backed that suddenly have investors. Like I think it was recently when there was a founder that told me that they already raised about 200K from angels at some multi-million valuation. And to me, it's painfully obvious that their business model is not venture growth, that they will not be 100 million company or $1 billion company valuation ever. They could be at least until they completely pivot, right? So what's important there is think really, really hard on not only whether you should raise money or not, but also that are you really building a company that can feasibly grow to $1 billion valuation and 100 million ARR at least, you know, later stages, maybe $1 billion ARR. If you cannot draw a path from where you are to $1 billion ARR, then don't raise venture capital. And then you should also understand that there is a big step change between you never raised the venture capital and you raise some. Because when you raised even the first 100K, 200K, it changes so much about your company, right? So for example, when you own by yourself as a single person 100% or together with your co-founder like 50-50 your company, right? And you have no investors, the most important thing you can do is you can distribute profits to yourself as dividends and basically live off that. The moment you have angel investor or VCs, you shouldn't do that, right? You should be careful that you can live only on the salary, and your salary should be something that makes sense to your investors, because you know you don't want your investors to be unhappy that you're paying yourself too much salary. And then you should also understand that your investors will only be happy if you will grow significantly on valuation, and they don't really care on your profits or your revenue, but they only care as it leads you to a higher valuation, right? And you basically, for example, very significant thing is that, are you able to live on low salary for many years and then be basically depend on luck and skill on two components on whether you will be rich or get to nowhere, right? So, or bankrupt, or at least the company will bankrupt. You will probably not personally. Versus when you are bootstrapping, you can put any payout that makes sense to you, as I said, through dividends or through salary, and you will probably not get a rainfall of hundreds of millions of dollars ever, but you will have a much more comfortable life sooner without being without having to respond to anybody. And here's to finalize this thing. The one important thing is, do you really want to be judged whether you're unique or not, or do you want to build a good business? Because the moment you raise in venture capital, the thing that everybody wants to see is, are you unique? Are you next Apple, Google, Facebook, but not exactly the same company? Something that never existed before, something completely new, something so big that nobody could think about it, like next Amazon, right? Or next something like next Okta, for smaller companies. But when you are building a bootstrapped company, you don't need to be unique. You can build just a great business that understand what product your customers need. You can build the product, you can sell the product, and you don't have to answer questions. How is it different from X? Or what will happen if Google will do the exact same feature? You don't have to answer to anybody that. You just need to have happy customers. And I think this is the biggest difference. I've seen great entrepreneurs building great companies, which are fairly not unique, but then they would make millions every year and be happy.
Okay, I think that's great. I think it's good perspective. Well, cool. Well, we're about at time. Ihar, obviously, thank you very much. I thought this was excellent. I think I saw some positive comments in the chat as well. I think it was just great how honest you were with the founders here. So what I'll do is I'm going to share your LinkedIn in the chat. I'll also share a link to the Geek Ventures website, which has right in the front there that you can pitch us. I think there's a link there.
Yes.
Start filling
So
out
there's
the
a
form.
button to fill the form. And just to be very clear, right? So if you write me on LinkedIn or email asking to look at your startup, I will direct it to the same form. So yeah.
All right. Easy enough. Okay, cool. Clear. The form is right there. If everyone who's still listening clicks the link, if you're interested, submit the form. And that's the best way to get in front of Ihar and get in front of the Geek team. But Ihar, thanks again. Really appreciate it. Really appreciate the transparency, the honesty. And thanks again for everyone else for joining.
Thank you all, guys. Thank you. That was great.
Thanks. All right.